Hi everyone, welcome back to our channel Educare Coaching Academy. Here I am again before you with another video. In this video I will be discussing about an important subject which is titled here as Key Performance Indicators or KPIs in short. In the business world, understanding KPIs are also called Key Success Indicators, KSIs, but commonly called KPIs, Key Performance Indicators. So understanding KPIs is very crucial and significant from the point of view of one who is either a beginner or an experienced investor. And having a better idea about these metrics or measures can help one in making informed investment decisions with regard to various activities of a business organization. In the financial language, KPIs are said to be a set of quantitative measurements, quantifiable measurements used mainly to measure a company's overall long-term performance in the strategic, financial, and operational areas and compare these metrics or measures with its competitors. And the same metrics can be used to measure the performance of various other investment activities of the same company also. And it can be used to measure the performance of its competitors or peers in the same industry. And here in this video, we have identified 10 key performance indicators. These are not complete, but these are the most commonly used and most commonly talked about KPIs in the business arena. Let's get started with the first one. Here, the first one is mentioned, return on investment is the first one mentioned here. Is the first KPI indicated here. It means how much money your business made compared to your investment. It's a measure of the profit earned from an investment. It is generally expressed as a percentage. It is in percentages usually. So and so percentage of ROI. So for example, 10% of ROI or 15% of ROI or 35%. So it is usually expressed in percentages. So it is the profit earned, measure of the profit earned from the investment. It is generally expressed in percentages, and it measures the efficiency of the investment, or it can be used to compare the efficiencies of various investments. And it is founded by a formula, income from asset divided by asset invested. So there are certain formulas also, the way by which these KPIs are found out. So return on investment is founded by income from asset divided by asset invested. So this is one of the major KPIs or measures used by the business all around the world. And next we can go to return on equity, ROE, return on equity. Here, when we look here, it is showing, it measures the return on shareholders' equity. It's a measure of the profitability of a business in relation to the equity. Shareholders' equity is calculated by taking all assets and subtracting all liabilities. So it is founded by this formula, net income divided by shareholders' equity. Shareholders' equity is calculated by taking all assets and subtracting all liabilities from them. So the balance, the residue is called shareholders' equity. Asset minus liabilities is called shareholders' equity. So what is the profitability in terms of or in relation to the equity shareholders? That is called return on equity. This is also an important measure used by the business world. And this is the third one, earnings per share. Is a company's profitability per share. Company's profitability on a per share basis. A company's profit divided by the outstanding shares of its common stock. Outstanding shares and common stock. These two terms are worth noting. Outstanding shares and common stock. So what is a common stock? Common stock is said to be a tradable asset or security that represents the stock of shareholders' ownership in a company. So these common stockholders or shareholders do have a representation as they have a representation in the form of an ownership in the company. So this is a privilege of the common stockholders or the common shareholders, equity shareholders. So they are called equity shareholders because they do have an ownership in the company. So their ownership is translated into a claim on the company's profit. So they do have an ownership, and that ownership is a claim on the profit of the company. It does mean that if the company makes profit, these common shareholders do have a right to have a claim on that profit. But the profit distribution or the dispersal of the profit is up to the management. So it's a decision of the management. But still, these common shareholders do have a claim on the profit of the company because they do have an ownership. They are represented by an ownership. And outstanding shares are numbers of common stocks a company has issued to investors or its own company executives, insiders. So that is called outstanding shares. And these outstanding shares and common stocks are the two terms referred here. And these earnings per share is a company's profitability per share. And it is company's profit divided by the outstanding shares of its common stock, not other sections of the stocks, but the common stock is taken into account and the outstanding shares of the common stock is taken into account. And when the company's profit is divided by this outstanding shares of the common stock, we are getting earnings per share. So that is also one of the most commonly relied upon KPIs by the business community and is investors. And then we are looking into price to earning ratio. This is yet another important metric or measure widely used in the business world. So it is called price of a company's shares relative to its earnings. This is also commonly known as PE ratio, price to earning ratio. This ratio is a measurement of what the market is willing to pay for the current operations, as well as the prospective growth of the company. So it is a price the investors are willing to pay for acquiring the shares of a company. If the ratio is high, the market seems to be taking the company's growth potential highly. It means the investors do have an interest in the shares of the company. Then what is a good P ratio? If the P ratio is high, it seems to be good. Then what is a good P ratio? A P ratio above 0 means a company is profitable, generally. And P ratio below 15 are considered low, and ratios above 20 are considered high also. And this is founded by the formula market price per share divided by earnings per share. Earnings per share is mentioned and discussed here. So this is the fourth KPI. And now we are moving to the next one. It is called dividend yield, DY ratio. It is called dividend yield ratio. It is also called dividend price ratio. And it is return on investment from dividends. Return on investments from dividends. So once the company pays out the dividend, the shareholders or the investors can measure how much return on their investment in terms of the dividends they are getting or dividends they got. So this is measured by this ratio, dividend yield ratio, dividend price ratio, and it is a dividend per share divided by the market price per share. So market price per share is the prevailing market price of the shares of the outstanding shares of the common stock of the company. A good dividend yield ratio is considered to be from 2% to 6%. So if the dividend yield ratio, DY ratio is between 2% and 6%, it is considered to be good. If it is below, it is not said to be fair. If it is above 6, it is considered as very suggestible dividend yield ratio. And if any particular investor is taking this particular KPI into consideration only, they can go for the investment. They can think about investment in a particular company which has a dividend yield ratio much above 6%. And this is founded by annual dividend per share by market price per share. And this is a return on investment from dividend. And this is also one of the important KPIs used by the investors and other relevant stakeholders. And now we are moving to debt to equity ratio. So what is debt and what is equity? Debt is an obligation. Debt is an obligation of the company towards outsiders. So that can emerge in the form of loans taken or other financial assistance acquired from the outside parties. So that is an obligation. So that is used to finance the operations of the company. So normally when it is raising capital for its present or current or future projects, the corporations go for the raising of the capital. So the raising of the capital can happen in many various ways. So debt is one such important methods used by the corporations or the business organizations to raise the capital. So if this ratio is used, it can be known how much debt it has in relation to its assets. It represents how much debt a company has compared to its assets. It measures a company's financial leverage. Here, a term to be noted is leverage. What is leverage? Leverage in business parlance means the amount of debt a company has in its mix of debt and equity in its capital structure. So capital is structured in such a way that it involves debt and equity. That is up to the company. So various companies do have various capital structures. So they may have a mix of capital. They may have mix of debt and equity. Some companies go for debt higher than their equity. Some companies may have more equity than the debt, but it varies from company to company. It all depends on the company's management decision. But it still has some kind of capital structure, and if it involves some kind of debt and equity, and that debt's proportion to the equity is known by arriving at this debt to equity ratio. So that measures the company's financial leverage. That is founded by total liabilities divided by shareholders' equity. More is the debt, a company is highly leveraged. Debt is more than the equity, highly leveraged company. And if the debt is less than the equity, it is not that much highly leveraged. But still, the debt scenario is not a bad thing at all. Leverage is not necessarily bad, as almost all business organizations make use of debt in the capital structure. So this is called debt to equity ratio. So this measures the company's financial leverage. So financial leverage is an important term to be understood. And leverage always is attributed to the proportion of attributed to the term debt. So debt is an outside obligation. So what is called current ratio? That is the next KPI mentioned here. So it is widely known. Current ratio is the proportion of current assets to the current liabilities. It gives a picture of how much of a current company's current assets in relation to its current liabilities. The company's ability to pay its current liabilities with the current assets. So if the current assets are more, its position is somewhat secure. If the current liabilities is more than the current assets, its financial position is not said to be secure. So to know the company's ability to pay off its short-term financial obligations in the form of current liabilities, we will have to know the current ratio. So that is the ratio proportion between current assets and current liabilities. When current assets are divided by current liabilities, we are getting the current ratio. And if the current ratio is if the current ratio is if the current assets are more than the current liabilities, it's a secure position as far as the business is concerned. Then quick ratio is mentioned here. Quick ratio is somewhat a filtered ratio than the filter ratio from the current ratio. So current ratio, in current ratio, we take the current assets totally, but in quick ratio, we have the quick assets. So quick assets means when we subtract inventories from the current assets, we get the quick asset. And the ratio between quick assets and current liabilities is quick ratio. And that quick ratio is showing a little more healthier position because more liquid cash is available in the hands of the business to pay off its immediate or short-term liabilities. Current assets minus inventories, that is quick assets, divided by current liabilities is quick ratio. And it shows a company's ability to pay its short-term debts or obligations with its current assets. And next is, so this quick ratio is also called asset to ratio. And it is essentially this ratio is figuring out if a company has enough liquid assets, that is current assets minus inventories. Inventories are not that much easily converted into cash. So we deduct inventories from the current assets, then we get the quick assets. And we can convert to that quick assets, we can convert the current liabilities, or we can pay off or finance current liabilities using the quick assets. So liquid assets are those that can easily be converted into cash. So that are called quick assets. Then we are going to talk about gross margin ratio. It is also called gross profit margin. It's a financial metric used by, this measure is used by it is used to measure a company's profitability by comparing its gross profit to its net sales. So here gross margin ratio measures the profitability of a company's products or services. Measures the profitability of a company's products or services. So gross margin or gross profit, that is revenue, total revenue minus cost of goods sold is gross margin or gross profit, and that is divided by revenue. Total revenue is called gross margin ratio, gross profit margin ratio. It helps the business in understanding how much money is left after covering the cost of goods sold. Cost of goods sold is the sum of the direct cost associated with making a product. So this is also one of the major KPI used by the business organizations. And last but not the least is net promoter score. It is used to measure the customer loyalty towards the company. It's a metric or measure used in customer experience programs. It measures the loyalty of customers to a company. This is a market research metric based on a single survey. It's something related to the market research and customer loyalty measurement, etc. So percentage of promoters minus percentage of detractors. So these are the 10 most important, but not, the list is not complete, but these are the 10 most important KPIs used commonly by business entities all around the world. Okay, you have them all now. Thank you for watching this video. Hope this is helpful and useful for you to understand basically about the KPIs and various KPIs. You don't forget to like this video and subscribe to my channel for more such educative contents. Stay happy and until next time, bye.